Well, let's change it from an annuity to an annuity due. Now, remember what I said about the first law of cash flow. Money sooner is worth more. Notice that the annuity has the payment at the end of the period. So your first payment occurs at the end of the period. With an annuity due, the payment occurs at the beginning of the period. The beginning of the period. So, before we even start, if this changed from end of period to beginning of period, do you think it would be worth more? Use the first law and trust it. The first law says that money sooner is worth more. So if you took all of these payments and all of them just jumped over by one period, would it be worth more? The answer, without even calculating, is yes, it would. Why? Because we're getting money sooner. Look, this first $3,000 has to be discounted for one period. But if we got it at the beginning of the period, it wouldn't have to be discounted at all. It would be worth the full $3,000. Being worth more. Every cash flow would be worth more. The second one wouldn't have to be discounted for two periods. It would only have to be discounted for one, thereby making it worth more. So an annuity due, look down here, the present value of an annuity due is always greater than the present value of an ordinary annuity. So all we do, look at the formula we have here. Look how we would modify it. It would be the payment. Notice I just put a payment out here. Why? Is because the first payment is 1. So the present value equals the first payment, period, is never discounted. So it equals the payment plus everything else we would just calculate as an ordinary annuity. So with an ordinary annuity, it looks like this. With an annuity due, the first payment we get in full, and now our annuity is only n-1 periods long. So all we did was, look inside the bracket here, we just put n-1, and we took one payment and put it on the outside. So all of this in here, all of this is all of this with a -1 in it, and we took one payment and put it out because we don't discount money we have in our pocket today. If we have $1 in our pocket today, what's the present value of it? It's presently in my pocket. It's worth $1. I don't have to discount it. But if it's in your pocket and I'm not going to see you till tomorrow, well, I got to discount it for a day, right? Why do we bother with this? What's the difference between an annuity and an annuity due? Well, think about paying your rent. Do you pay it at the end of the month or the beginning of the month? Well, you pay it at the beginning of the month. So for your landlord, it's an annuity due. Why does your landlord want you to pay it at the beginning of the month? Because sooner cash flows are worth more. Now, here's what's really interesting. When is his mortgage due? At the end of the period, not at the beginning of the period. So he collects his money at the beginning of the period and makes his payment at the end of the period. Clever, huh? Your cell phone bill. Historically, a long time ago, going back 30, 40 years, you would use your phone service. There were no cell phones back then. It was home lines. But you would use your phone service, and then you get a bill for what you'd used. You'd pay it at the end of the period. And the phone company said, you know what? Annuity dues are worth more to us. The present value of it is worth more to us than a regular annuity. So let's start charging people at the beginning of the month before they even use it. So your cell phone, you pay at the beginning of the month, then you use it. Your cable bill, you pay at the beginning of the month, then you use it. Your insurance for your vehicle, you pay at the beginning of the month, and it covers the month. Your gym membership. So almost everything you pay is an annuity due for the person selling you the service. So if you have a business and you have customers, your job is to say, how do we get them to pay at the beginning of the period and not at the end of the period? Why? Because you're turning a regular annuity into an annuity due, and the present value of an annuity due is always worth more than the present value of an ordinary annuity, which is why everybody that sells you a service wants their money now, and then you can use the service, but you pay in advance because it's worth more. So let's do an example of what that would look like. Here is a situation where for 6 quarters, it's a year and a half, these are months, 3 months, 6 months, 9 months, 12 months, 15 and 18, where you're going to receive $2,000. You're the landlord of a building, and you've leased it to somebody, and they're going to pay you $2,000 a quarter. So when they move in, they pay you $2,000 at the beginning, and that $2,000 covers this period of time. At the end of the first quarter, they'll pay their $2,000 for the use of the place for the second quarter. At the end of the second quarter, they'll pay their $2,000 for the use of the place of the third quarter. So by the time we get to the 15th month, when they pay, they're paying for the end of period of time. There's no payment right at the end. This is an annuity due. So let's say you're the landlord of this building and you've just leased it out for 18 months, but you'd like to get some money today. Another company that buys the present value of your leases says, we'll buy the present value of the lease at 9%. Well, how much are you going to sell it to them today if it were 9%? Actually, let's make it 8%. Sorry, not 9. So let's say that you can sell it at a discount rate of 8%. And we have how many payments? We're going to get 6 payments. Our N is equal to 6. Well, you know you're going to get 2 times 6. You're going to get $12,000 over the next 15 months. But you want the money today. So you're willing to sell it to somebody. Well, what's the price? We need to know what the present value of all of that is. Now remember, since this is annuity due, the first $2,000 is worth $2,000. It's worth just straight $2,000. So we don't have to discount that. Plus, well, now we only have 5 payments left. So notice that we have our N minus 1 up here. So all we have to do is fill in our terms, right? Which equals 2,000 plus, and in brackets we have 1 plus 1 over. Now our R, it's 8%, but since it's quarterly, that turns into 2%, right? So it's 1.02. The N is still 6, but it's N minus 1, so it's to the power of 5 over 0.02 times our payment. Remember, this payment is just on its own. This is the present value of $1 for that period of time, but we don't want the present value of $1. We want the present value of $1 2,000 times. So we just multiply it by 2,000 in the end, and we will get 11,426. So you can sell this lease to somebody else, to a factor, who will then pay you $11,426 today and collect the $2,000 themselves, and they'll realize an 8% return compounded quarterly over the next year and a half for that right. Notice that you could have written this a different way. Now, this is just one derivation of the formula. Another way to write it, and the way that the book presents it, and I should present it to you, is that you could write it in terms of that the present value equals the payment times 1 plus, and then the 1 plus 1 over 1 plus R, N minus 1 over R. You can write it out that way. Now, what's the difference between these two ways of writing it? Well, expand the terms. Payment times 1 is payment, plus payment times this term. Well, there's this term times payment. So all this is doing is taking payment and collecting it as the common term and adding a 1 plus something. But if you expanded it, you multiply payment by this plus payment by this, which is just this. That's all it is. So you have to be able to look at a formula and say, well, I can manipulate it into whatever way I want to look at it. And which way do you want to use it? Whatever way you feel comfortable with. I personally like it like this, in this form, because it reminds me that this first payment, it tells me straight up, I got an annuity due and I'm not discounting this payment. I can see clearly that I'm not discounting it. I like that idea. Let's look at a deferred annuity. And why do we want to talk about a deferred annuity? Here's why. You may invest in a project that for the first 4 years requires nothing but waiting. Nothing's going to happen. And then you'll start receiving cash flows. That's the typical way that most projects work. Well, when you invest money today and then you wait a number of periods before you receive your first payment, but then you'll receive it every period after, that is called an annuity, a deferred annuity. Why? It's still an annuity, but it's deferred. But there's a little trick in here. You can call it a deferred ordinary annuity, or you can call it a deferred annuity due. It's the same thing. So, on this date here, 1 period before the first payment, what am I looking at? I'm looking at an ordinary annuity. Why? Because every payment is at the end of the period. So if I start valuing it here, I would value it as an ordinary annuity. If I started valuing it at the first payment, notice that the payments now are at the beginning of the terms, I would value it as an annuity due. Whichever way we take, we'll get the same answer. To figure out this, it is a two-step process. Step number 1, either determine the value of the ordinary annuity as of this date, or determine the value of an annuity due at this date. Well, that's as of this date, but we want it as of the present value. So we would discount it by 1 plus R. So if our deferred annuity was deferred for 3 years, we would calculate it as an annuity due discounted by 1 plus R to the 3. If we calculated it here as an ordinary annuity, on the other hand, then we only have to bring it back 2 periods. It would be 1 plus R to the n minus 1. So let me prove to you that these 2 ways work. It depends on which way do you feel more comfortable with. They both have the same answer. So let's say we have a situation where we are not going to receive any money for 3 years. Then we're going to receive $1,000 every year for 5 years, and we have a discount rate of 5%. What is the present value? Well, the first decision we have to make is, are we going to discount it back to this period of time, or are we going to discount it back to 1 year before? In other words, are we going to treat this $1,000 as an annuity due or as an ordinary annuity? Let's do it both ways. So if I do it as an annuity due, my present value will equal what? My first payment, which is not discounted. I'm using this formula in the top corner here. It's not discounted, right? Plus 1, and I'll put that in brackets, minus 1 over, what's my discount rate? 5%. Do I have to divide it by anything? No, it's annual. So I can leave it as 1.05, can't I? 1.05. And how many periods do I have? I have n minus 1 periods. Why? Because the first payment is outside. I get that on its own. So it's 1.05 to the 4 divided by, all of this, is divided by 0.05 times $1,000. What am I going to get if I figure all this out? I will get, over here, I will get 45, 45, 95. So, as of this date, I have 45, 45, 95. But I need it as of the present value over here, which is 3 years. So we've got to bring this money back 3 years. Well, it's very easy to bring it back. You just divide it by 1.05 to the power of 3, and we will get 39, 26, 97. So there we go. Does it work for the ordinary annuity? Will we get the same thing if we do it for the ordinary annuity? Well, let's find out. The present value here, the payment is not inside, mind you. It's just this term to the power n times the payment. So what would we get on that term? We would get 1 minus 1 over 1.05 to the 5. Notice this was to the 4, but this is to the 5. Divided by 0.05 times our 1,000. Will give us 43.29. Notice that on the annuity due, we got 45.45. But on the ordinary annuity, we got 43.29. Does that make sense? Yes, it does. Why? Because I told you the present value of an annuity due will always be greater than the present value of an ordinary annuity. So now we have, this is as of this period of time. So now we have to bring it back 2 years to get the present value. So we just divide by 1.05 squared. And what will that give us? That will give us 39.27, 39.27 versus 39.26.97. Anyone can see those are equal except for 3 cents. So for a deferred annuity, you can calculate it as an annuity due and then bring it back by the time lag, which was 3 years. Or you can calculate it as an ordinary annuity and bring it back by the time lag minus 1, which is n minus 1 years. So in either case, you're going to have an n minus 1. In your ordinary annuity, you have n minus 1 in your second step. In your annuity due, you have n minus 1 inside your brackets here in your first step. Either way, you get the same answer. So we've been calculating present value the whole time, but how do we calculate future value of an annuity? And you may say, well, what does that look like? Give me an example of what it would look like. Well, let's say you make regular contributions to an RRSP, and the RRSP holds one asset, a mutual fund, that pays a fairly constant rate of return. How much will you have in 30 years? If you make an annual contribution to your RSP, in other words, you're going to part with money at the end of the first year, you're going to part with some money at the end of the second year, you're going to part with money at the end of the third year, etc., 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 and then at some future point you get your cash out. What is the future value of that annuity? We've been looking in terms of, well, we get money in each of these terms, what's the present value? But we might have to figure out the future value of an annuity, and you may wonder, for businesses, what does that look like? Well, let's say that you're working for a home builder, and over the next 2 years, you're going to be developing a neighborhood, and it requires you to part with $100,000 at the end of every week for the next 4 years. Well, what does that amount to? Because that'll be the value of the loan that you owe, right? So we can look at it in terms of that. If you have an arrangement with the bank that's going to forward you on your line of credit $100,000 a week for the next 2 years, at the end of the 2 years, when you sell all the lots, how much do you owe the bank? So that's the future value of an annuity, because it's negative cash flows, right? So it's easy to figure out the future value. I can show you algebraically all the steps. I can start with the present value and show you algebraically all the steps, but it's easier just to show you, I think. 1 plus r to the n minus 1 over r. Notice that in the previous example, for future value, we had 1 minus 1 over 1 plus r to the n when we're discounting. Why? Because we're discounting. So it's in the denominator. But now we're moving forward, we're compounding, so it's 1 plus r to the n. These terms are just reversed, and these are inverted. That's all it is, over r times the dollar value of the payment. So it's the same formula, except you're just reversing the two terms and inverting this number, or taking off the negative sign. That's all it is. Why? Because we're not moving backwards, we're moving forwards. There's no need for the negative sign. There's no need for discounting. We are now compounding. Well, that's the future value of an annuity, where cash flows leave every single month. But what's the future value of an annuity due, where cash flows leave at the beginning of each month? Well, it's not that difficult to do. It's the same 1 plus r to the n minus 1 over r. And since we're getting at the beginning of the term, by the time you get to the end of the term, notice that these 4 are these 4. They're the same thing. These 4 are these 4. All we're doing is we're shifting it up one, so there it is right here. It should be the same thing, but all 4 of them now have to be carried for one more period. They have to be carried for one more period, right? So whatever we get here, all 4 have to be carried one more period, so there's the 1 plus r. Take all of that and multiply it by the value of the payment. There we go. I show you these formulas, and every book is going to go through the formulas. But here's the reality at the end of the chapter, and we only tell you this at the end of the chapter. We're going to do this in Excel. You don't have to memorize these formulas. In fact, all you have to do is learn how to tell Excel to calculate it for you. That's it. I don't think we're ever going back to the point where you have to calculate this with pen and paper, ever. But here's the deal. While you can learn how to tell Excel how to do it, unless you intuitively see how it's done yourself, you'll never truly understand how to change this formula and how to change what you tell Excel to account for circumstances that aren't the ordinary circumstances you come across. So you look at a couple of situations, say, I get it, but this one's odd. It has overlapping cash flows in and out. How do I deal with that? And each cash flow, the cash flows out, have a different discount rate than the cash flows in. How do I deal with that? Well, unless you understand how we derived all of this and the logic behind the steps, all you're doing is all in the, if you don't understand, in the end, all you are is a parrot. All you can do is parrot to Excel what's on the paper somewhere. Oh, well, put this, and it's not working. And then all you can do is throw up your arms and go, I don't get it. It's because that's exactly it. It's because you don't get it. You really have to struggle with this. You really have to get to come to terms with these formulas and say, okay, I understand how they're calculated, but here's the deal. I'll never actually calculate it. I'm just going to tell Excel how to calculate it. But since I know how Excel calculates it, I know how to handle all those special cases that can jump up because I know what I need to tell Excel. So we're going to focus on that. I've talked too long on that. All right, let's get back to the chapter. Let's do some net present value stuff.